In the financial world, volatility is not a possibility. It is an inevitability. Every seasoned investor understands that economic cycles, much like the seasons, always turn. The key question is not if another downturn is coming, but whether your personal financial architecture is built to withstand the approaching storm. Many individuals were caught unprepared during the 2008 crisis, and again during the shocks of 2020. Their downfall wasn't the market itself, but the lack of a proactive defense strategy. This detailed analysis is designed to provide you with a comprehensive roadmap. We will outline the 7 critical financial maneuvers you must execute now to inoculate your portfolio and your household finances against the next severe economic recession. This is not about panic, it is about preparation. 1. Build a robust cash reserve. The primary line of defense against any economic downturn is a robust cash reserve, commonly known as an emergency fund. During stable periods, 3 to 6 months of living expenses is often cited as the standard. However, during a deep recession, job loss can be prolonged and market recovery can be slow. Therefore, our recommendation is to increase this moat to a minimum of 9 to 12 months of essential expenses. The strategy: this capital should be held in highly liquid, low-risk accounts. Think high-yield savings accounts or short-term treasury bills. This reserve is your financial parachute, ensuring you never have to sell valuable assets at their lowest possible valuation just to cover a utility bill. 2. Eliminate high-interest debt. High-interest consumer debt, especially credit card balances, is the single greatest liability during an economic contraction. Why? Because those interest payments act as a fixed, non-negotiable expense that rapidly consumes your shrinking cash flow. The protocol: adopt a disciplined approach such as the debt snowball or debt avalanche method to systematically retire these balances. Every dollar paid toward a 20% interest rate is equivalent to a guaranteed, tax-free 20% return. In a crisis, eliminating this debt provides maximum flexibility and reduces your monthly burden when it matters most. 3. Create a secondary income stream. Placing all reliance on a single income source is the antithesis of resilience. Recessions often lead to layoffs, even in historically stable industries. The implementation: develop at least one secondary or redundant income stream. This could be freelance consulting using your high-demand skills, developing and selling scalable digital products, or launching a niche content channel like YouTube that earns passive ad revenue. The secondary income mitigates the catastrophe of job loss, transforming a crisis into merely a temporary setback. 4. Adjust your portfolio for defensive sectors. Not all sectors suffer equally during a downturn. Consumer discretionary spending falls, but essential services remain indispensable. The portfolio adjustment: review your allocation and shift exposure toward recession-resistant sectors like consumer staples, food, beverages, hygiene, healthcare, pharmaceutical and medical services, utilities, essential public services. This rebalancing dampens volatility and adds stability when growth stocks falter. 5. Keep capital ready for opportunities. While the goal is to survive the recession, the ultimate aim is to thrive afterward. History shows that the greatest wealth transfers occur during turmoil. The discipline: maintain a deliberate allocation of capital, separate from your emergency fund, reserved solely for investments. When markets panic and assets are heavily discounted, that cash becomes your fuel to acquire quality assets at generational lows. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Cash gives you the luxury to be greedy during fear. 6. Hedge against currency devaluation. A major risk in modern crises is inflation and currency decline. The diversification mandate: gold and silver, the classic hard assets, maintain intrinsic value when fiat currencies weaken. Allocate 5% to 10% of your capital to physical bullion or liquid ETFs. Not for profit, but for preservation of purchasing power. 7. Invest in your own skills. The most crucial investment in any economy is the one you make in yourself. When markets collapse, specialized, high-demand skills retain value. The action: dedicate time to mastering resilient skills, data analysis, advanced coding, financial modeling. Keep refining your financial knowledge, just as you're doing now. That's the ultimate long-term defense against systemic risk. These 7 maneuvers are not theories. They are a mindset shift. The time to prepare is not when the storm hits, but when the skies are still clear. Take action. Review your finances today and commit to executing at least one of these steps this week. If you found this analysis valuable, make sure to subscribe and turn on notifications.